Okay, I'll just quickly, what I'll do, quickly I'll just do the first part and then the last one. So the first part is in this sum, residual income. So you form the format.
Yeah.
Format is opening book value plus earnings minus dividend. Then you will have closing book value. Then here earning minus equity charge. Earning minus equity charge is
Residual income.
residual income. Opening book value
5.
5. Earning is return on equity 15%. Take 15%.
0.75.
Dividend pays no dividend. So 5.75. That will be 5.75 here. But equity charge will be equity charge is going to be
10% of
10%. So 10% of 5.
0.5. Yeah.
That is
Yeah,
equal to what?
10% of
0.5.
0.5.
So 0.75 minus 0.5.
0.25.
0.25. Then here earnings is again 15% of this 5.75.
0.86.
0.86. No dividends. Add these two.
6.61.
6.61.
61.
Equity charge is 10%
10%
of
of 0.8.
5.75.
So 0.575.
So 0.86 minus 0.575.
0.86 minus 0.285.
15%.
0.99.
6.61 plus 0.99.
7.6.
7.6. Equity charge 10% of 6.61.
0.66.
0.99 minus 0.661.
0.33.
0.33.
33.
So this is for the next 5 years. This is year 1, 2, 3. Then fourth one. 7.6. 15% of this.
1.14. 7.6. 8.74. 0.76. 0.39. 1.31. 7.4. Wait. No. 7.43. 10% of 8. 0.874.
Hmm.
0.3.
Zero
This
point.
is this is fifth year, na?
Yeah. Hmm. Calculate.
We have missed something.
Correct only. How much is it coming to? 1.31 minus 0.874.
0.43.
It's correct
Yeah,
only.
it's correct.
0.44. Let's say. Okay. So now I'm directly jumping to the last one. It says suppose instead that at the end of year 5 we assume that Java's return on equity falls to a long run average. Instead of year 5 we assume that return on equity falls to a long run average level, and the price, that means long run average level means it's not only for level year 5, forever you are going to get this return.
Okay.
Okay, now long run average. Okay, we assume that Java's return on equity uh, hmm, return on equity falls to a, at the end of year 5 we assume Java's return on equity falls to a long run average level of this 0.44, but plus, okay, so this is the amount plus here the addition is price to book value is 1.2. So that means for one price to book, so if book value is 1, then 1.2 is the price. So here the book value is 7.4.
7.4. Opening book value is 8.74.
Okay, no, here it is saying 10.5. Yeah, you have not added it, you have reduced it. You are supposed to add now 8.74 plus 1.31 is not 7.4.
Oh, yeah, 10.05.
10.05. So for 10.05, what should be the price? Just calculate.
12.06.
12.06. That means it is the exaggeration of 10.05 minus. So extra value is how much?
Yeah, 2.01.
2.01. So market will give 2.01 more. So plus 2.01. Okay, that's it. Now as usual, 1 plus required rate of return is
10%.
10% raised to 1. You can keep it in cash flow function also if you want.
But sir, what will be CF0?
CF0 is initial opening cash flow 5.
5. Okay.
So that also you should add. This ending one is 0.44 plus 2.01.
Yeah.
But that language is quite odd. It says falls to a long run average level. We assume, suppose instead at the end of year 5, Okay, so this amount we will get, and then the market will price it little higher. Okay, anyways, you do now.
7.49, 7.5.
7.5, that's it. Is it okay? This one only they have complicated here unnecessarily. Made it like two steps. And rest, these all are easy only.
This the whole
All
theory.
self-reading. All
Yeah,
self-reading,
all
yeah. This one I told clean
you
surplus violation. This I already told you, right?
memory based.
Yeah, memory based. Here the purpose is you have to remember all this. Okay. Now clean surplus violation means normally
OCI
all income statements balance should go to the balance sheet.
balance sheet.
Okay. But instead of this is called clean surplus account.
Yeah.
Clean surplus. And OCI is when you do revaluation of assets and all such things will come over here. Okay. And then so instead of directly going to income statement, it is coming from OCI to
OCI to
balance sheet. Then it is
balance sheet.
called violation of clean
Violation of clean
surplus.
surplus. So if there is OCI in the scene, then it's
Hmm.
violation.
OCI is
If
there,
there
then
is,
violation of clean surplus
yeah,
account.
yeah.
So all these will lead to violation of clean surplus account. These 5-6 points.
Oh. Sir, in this on page number 181,
Hmm.
22 point B,
Hmm.
there is this compliance related valuation.
Okay. Yeah. See, private company valuation. Now, this chapter is a very easy one. It is more or less just a repetition of whatever we have done so far, but private company perspective. Okay. But still, you will find more or less many similarities. Okay. Now, company specific factors include stage of life cycle. Right. Company might be at the early stage. Okay. Growth stage, less mature than public. Okay. Size of the company, quality and depth of management. All these are the parameters to analyze a company, private company, quality of financial and other information. Okay. Then these all are self-reading only. Now here, 22 point B, describe uses of private business valuation and explain key areas of focus for financial. So this is what you were saying, right? 22 point B.
Yeah, in that, not this transaction related, compliance related valuations.
Okay. Now transaction related, I'll still explain. Transaction related valuation means you see, you will see in newspaper they will publish like this. So and so company has invested $1 million, and then they will say like, um, uh, so and so has invested $1 million, and so now the valuation of the company goes to this much. So just because somebody invested the value of the company is becoming $1 million company. So that is called, so venture capital is financed. So that is called transaction related valuations.
Okay.
Okay. So like Baiju is what? All transaction related valuation. Somebody, this person was investing, this company, that company was investing, and it became $1 billion company. Okay. Then IPO. Then that means you are valued by the public. Or you are selling it to somebody, sale in an acquisition. Somebody is acquiring you, or bankruptcy, performance based managerial compensation. Okay. So these are all transaction based. Compliance based valuation. So compliance based valuations are performed for legal or regulatory reasons. The primary focus on financial reporting and tax. They primarily focus on financial reporting and tax issues. Financial reporting, tax purposes. Okay, compliance related valuations are performed for legal or regulatory reasons, financial reporting and tax purposes. Okay. Valuations in this area are often related to goodwill impairment test, in which units of a public firm are valued using private company valuation. The reporting of a stock-based compensation also requires accurate valuation. Financial reporting. Valuation in this area are often related to goodwill impairment test, in which units of a public firm are valued using private company valuation methods. The reporting of stock-based compensation also require accurate valuation. At the firm level, transfer pricing, property taxes, and corporate restructuring may necessitate valuations. For individual equity owners, estate and gift tax may necessitate valuations. Okay. Goodwill. Okay. Are you able to understand? This is little difficult, right?
Yeah, I had this in doubt in this tool.
Yeah. So financial compliance related valuation. Compliance related valuations are performed for legal or regulatory reasons. They primarily focus on financial reporting and tax. Okay. Compliance related valuation. Okay. So valuation in this area are often related to goodwill impairment test, in which units of a public firm are valued using private company valuation methods. The reporting of stock-based compensation also requires accurate valuation.
The first line in financial reporting is something I did not understand.
Yeah. Okay. Valuation in this area are often related to goodwill impairment test, in which units of a public firm are valued using. Okay. Yeah. Valuation, compliance related valuations are performed. So basically, financial reporting means it is accounting related only. Accounting related. So now here, when they say valuations in this area are often related to goodwill impairment test, because for your private company, why do they for your private company or units of your public company, why are they calculating valuations? Why are they calculating valuation? Because in a private company, a lot many times goodwill can play a bigger role in that company.
Okay.
How goodwill can play a bigger role? Say for example, a small IT company is there. Now how will you value that IT company? That IT company may not have big assets. That IT company may not have good uh, you know that IT company may not have good assets. That IT company um, may not have good assets. So now it is so that company's valuation all will come based on goodwill only.
Okay.
Okay. There was one sum I think we did right last time, or I think it, or if not, no, it is there later stage, I think. This one. See this one. This sum. So, okay, when we do this sum, you will be able to understand. See, under the excess earning method, this is another method. The analyst starts with the earnings that should be generated by working capital and fixed assets based on estimates of the required return. Excess earnings are from earnings minus earnings required to provide the required rate of return on working capital. That means, see, a private company will be making a lot of more profits than what is required. It will be growing faster. Now, that means it is giving more than what is required. When it is giving more than what is required, then the rest of the returns are attributed to whom? That means it has some intangible talent or intangible assets. You understood what I'm trying to say here?
Yeah.
Because a private company, I'll repeat, a company has some working capital, some fixed assets, let's say. Now, but the working capital and fixed assets also, there will be some expectations that if I'm having some working capital and some fixed assets, how much return I have to get out of this. Okay.
Okay.
So imagine the asset turnover is very high, or the profit is very high. So when it is exceeding, whom will you attribute that to? So that will be all goodwill of the company, which is able to create such a massive profit. Okay, and that you have to report it in the financial reporting only. In the financial reporting, this that means when you report it or when you do accounting, then only that profit will come up. In short, it is the normal accounting profit, you can say. Business accounting profit. You are doing business and then you are doing accounting. That is financial reporting.
So, excess profit that a company has generated through limited assets,
Yes.
and that reason for that excess profit is their goodwill.
Yes, then it will be attributed to their goodwill only, right? Okay, which you will come to know only when you do financial reporting. Otherwise, you cannot prove it, right?
Yeah.
So compliance, you can simply even understand that compliance means as per the rule you are supposed to do financial reporting. That is also okay. So as per the financial reporting, what is the value? That is a simpler way also to understand. But because they have said here goodwill, then you will have that doubt why goodwill is coming here. Okay, so goodwill comes in a private company because they get more profits than what they are supposed to get.
Hello.
Yeah. Okay.
Then that tax one also.
At the firm level, transfer pricing, property taxes, and corporate restructuring may necessitate valuations. That means this is the reason why valuation is needed. Transfer pricing, that means you might be just, you might have been acquired by somebody. So quite possible that, that company is only acting as your client. That means a lot of manipulations are possible.
Transfer pricing means
Just
like
1 minute, 1 minute. So transfer pricing means what happens is when your subsidiary and the acquirer, they both are, say for example, there is an acquirer, there is a subsidiary.
Hmm.
Now obviously there can be a lot of manipulations. How? Because this company is the parent company, let's say, and this is subsidiary. So quite possible that parent company will say, look, subsidiary, you sell products to me at the lower price, so that
Okay.
this parent company's profit goes up. Or they might, that is possible, they will
Yeah.
get raw materials from here, and then further they will sell it at the higher price to the subsidiary. That is also
Okay.
possible. So they can
Yeah.
adjust the price as per the requirement, increase, decrease, decrease, increase.
Hmm.
So that is called transfer pricing. At what price? So there are certain rules like how the accounting has to be done. So
Hmm.
that means what? That means you have to value it in such cases, because you will not know otherwise the true valuation of the company. Otherwise, they can easily say that, I purchased, subsidiary will say I purchased this much from the acquirer will say I sold this much to the subsidiary.
Hmm.
They in the purchase also they can be each other's client, and in the sales also they can be each other's client, and they
Yeah.
can influence the price.
Yeah.
So that's why price is, the valuation is needed.
Hmm.
Then property taxes, then corporate, for paying taxes also you need to know the value, na? Then only you will pay
Yeah.
tax.
Yeah.
Then corporate restructuring also you need to know the value.
Yeah.
Okay. So yeah, so how you can understand this is, financial reporting is normal business accounting that
Hmm.
will help you to know what is the goodwill of the company,
Hmm.
how much company is able to make additional profits.
Hmm.
Okay, and then for tax purposes also you need to know the valuation. These are all compliance related valuations.
Okay.
Then litigations is simple, like, litigations is when company goes into bankruptcy.
Hmm.
Valuations may be required for shareholder suits, damage
Hmm.
claims, lost profits, insurance claims, or divorce settlements. Okay.
Yeah.
Then normalized earnings. Normalized earnings. Yeah, this is a very easy one only. Just go through this question. You just have to do plus minus. Just go through this question.
That's it.
Right? See. Tim Grow is the principal shareholder, CEO, and founder of Arbitrus Generators. Arbitrus reports the three following annual figures.
Hmm.
Annual compensation of 2.5 million is included in the firm's selling, general, and administration. Arbitrage leases a warehouse for 100,000 a year from one of its largest suppliers. Arbitrage owns a vacant office building with reported SG&A expenses of 150,000 and 25,000 of depreciation expense, and analyst determines that the market-based compensation. Here is the change. See, gross compensation is 2.5, but market-based compensation is 1 million only. Okay, and the office
Okay.
building is not needed for core operations. The market lease rate of the warehouse is 130,000 per year. Based on the three annual figures just listed, what adjustment should the analyst make to Arbutus's reported income to estimate normalized earning, assuming the firm will be acquired? Okay, so if the firm is acquired, what will be the normalized earning? So
Okay.
it is earning right now how much? Uh, okay, see, compensation is 2.5, but the market compensation is 1 million. That means if you acquire, you will get extra 1.5 because you have to pay only 1 million. So
Okay.
plus 1.5 because of salary. Is this okay?
So if I acquire this business, I have to pay more 1.5.
No, you have to pay less 1.5, no? So that's why your income will go up because already the
Okay.
salary, this company is drawing the salary
Hmm.
of 2.5. Once you
Hmm.
acquire in the market, the salary should be only 1 million.
Hmm.
So you will pay 1 million means you will save 1.5.
Hmm. Hmm.
So your income will go up.
Okay.
Okay. The next one, Arbitrage leases a warehouse for 100,000 a year from one of its largest supplier. Now here it says that the office building, okay, office building is coming here in the third one. Market lease of the warehouse is 130,000.
But
So
we are leasing it for what? 100,000.
company is leasing it for 100,000. We are the
Yeah.
acquirer. So if we take it, we have to pay 130. That means
Yeah.
we
So
have to spend minus
minus 30.
30,000. So this is 1.5 million. Okay. And then minus 30,000. Okay. This is leases. The next one is vacant building with reported SG&A of 150,000, expenses and 25,000 depreciation. Here it says office building is not needed only. So you will save these expenses and depreciation also. So
So 175.
yeah, plus 175,000. Okay. Hmm. 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 That's it. Now you can read it.
Got it.
Hmm. Estimating cash flow. Again, this is free cash flow. So this is free cash flow. Uh, this is again ditto what we have done before.
Yeah.
Yeah. Just go through this. Yeah, this is ditto what we have done before. Uh, okay, just go through this question then.
Yeah, done, sir.
Huh. An analyst has normalized the earnings and expenses for a private firm under consideration of as an acquisition. Because the capital structure is non-optimal, the analyst assumes that the capital structure will be changed if the firm is acquired and will use the free cash flow approach to value the firm. The following assumptions are used to create a pro forma income statements and to estimate FCFF. Current revenue 20 million. Revenue growth, gross profit margin. Depreciation expense as a percentage of sales. Working capital as a percentage of sales. SG&A and 30 percentage. Additionally, capital expenditure will cover depreciation 10 plus 6% of the firm's incremental revenue. Create a pro forma income statement and estimate FCFF. Okay. Additionally, capital expenditure will cover depreciation. Okay. It is just normal. First, what they have done is, okay. Additionally, capital expenditure, okay, pro forma for, okay, income statement and FCFF. Fine. So first we have to calculate income statement. So income statement is $20 million sales. Which are revenue growth. So plus 4% you do.
20,800,000.
Okay. Then gross profit margin is 30%. So take 30% of 20,800,000.
6.24 million.
6,240,000. 6,240, right? 000. Correct?
Yeah.
So cost of goods sold is, take the difference.
14.56 million.
14.
0.56 million. 40. Sir.
Is it right?
Yeah.
Now you just check again whether this 6,240,000 is coming to 30%. 6,240,000 divided by 20,800,000.
%30.
The next one is depreciation SG&A expenses 220,000.
So minus SG&A.
Yeah, 220,000.
It's 1236.
What 1236?
12.36 million.
You added or you subtracted?
Subtracted.
So it is 1.1
Oh, wait.
million, 1.236.
Yeah. Sorry. I subtracted it from COG. So
Calculate the entire
Yeah.
number. 6240,000 minus 220,000.
6020,000.
This will be EBITDA minus depreciation. Depreciation expense as a percentage, 2% of this amount.
Sir, it's not 220,000, it's 2.2 million.
You tell me the entire number. Which
No,
million
this
you are speaking?
SG&A, it's million. One more zero will come. And that is 2 624,000 minus 2. The answer is 4040,000.
Answer means which answer?
EBITDA is 4040,000.
4040,000.
Yeah.
Now what is depreciation?
Depreciation is 2% of sales.
Hmm.
So 4,16,000.
And what is EBIT?
36,24,000.
Hmm?
36,24,000. Then tax is 30%.
Interest is not there.
Yeah. EBT.
Tax is
10,87,200.
30%.
Yeah, 30%.
How
10
much?
lakh 87,200. And 36, 25 lakh 36,800.
It's matching.
Yeah.
Yeah, after tax. Now free cash flow to the firm. So free cash flow to the firm is net income plus
Depreciation plus interest minus working capital minus fixed capital.
so net income is 2536,800.
Depreciation is 416.
Interest is nothing.
Yeah.
Working capital is 10% of sales. You do.
Working capital is 10% of sales.
It means 208 double zero double
208
zero.
0000.
Okay. Then fixed capital investments.
Then fixed capital
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 expenditure will
expenditure
cover
will cover.
depreciation plus 6% of the firm's incremental revenues. So 6% of 800,000. 6% of 800,000 plus depreciation. Depreciation is 416,000.
What were I did not understand this.
Depreciation is equal to capital expenditure is equal to depreciation plus 6% of the firm's incremental revenue.
Huh.
So this is firm's incremental revenue, 6
Okay.
percentage,
Okay. Okay.
and 416,000. This becomes fixed capital investments.
Okay. 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 464. 4,64,000.
Now you calculate. Yeah, it is all matching. Working capital, they said 80,000.
10
This
percentage of increased in sales is mostly.
working capital as a percentage of sales, but here they have taken, so there is a printing error, increase
Hmm.
in 80,000. So it's a printing error, 10% of increment.
Okay. Answer is 24 lakh 8,800.
Hmm. Yeah, this answer, right?
Yeah.
Okay, it's a very normal sum. Okay. The next one, discount rate. Discount rate in a private firm. Now, why will you apply discount rate? Okay. Now, why will you apply discount rate? So, because of size premiums, because it's a smaller company.
Yeah.
Okay. So, these are all the reasons. Again, theoretical one. These are all the reasons why discounts can be applied. Then, uh, this is the formula. Acha, this is levered and unlevered. Okay, this one.
I know this also, levered and unlevered.
Okay, it is covered in your college.
No, in this financial modeling, he has taught us.
Okay, fine then. Okay. So, but from my side, I'll just quickly then tell you. See, say for example, some unlisted company. Let's say for a minute, assume NSDL is not National Stock Exchange is unlisted.
Hmm.
So now we want to find out the beta of National Stock Exchange. Um, or which company got listed? NSDL, no?
Yeah,
No,
NSDL got listed right now.
recently, na
Yeah,
NSDL.
yeah.
So let's say CDSL is the listed company already. NSDL
Huh.
is not listed.
Huh.
Okay. So NSDL is not listed. I want to calculate its beta. So what will I do? First, I will check CDSL's beta. So
Okay.
that means beta CDSL's is the lever. Yeah, CDSL's beta.
Okay.
So CDSL beta of the public company. So let's say that is beta of that public company is, let's say, 1.2.
Hmm.
Now that I cannot directly use it. I can get inspired from CDSL's beta. So what I have to do is I have to do some adjustments. I will discount the debt, because of the debt its beta would have gone
Up.
up. So 1 plus, this is the formula, 1 plus
Hmm.
debt to equity ratio into 1 minus tax.
Hmm.
Okay. So that means based on the weight of the debt and tax adjusted weight of the debt, I am discounting.
Yeah.
So imagine it is 50-50 weight they have given.
Hmm.
So 1 by 1 into 1 minus 30% is the tax.
Hmm.
So that will come to 1.2 divided by 1 plus 0.70. Just calculate this.
50/50 is 1/1.
50/50. Debt 50, equity 50 is 1 by
Acha,
1.
acha, okay, 50. Okay. I thought half, like, got it. 1 plus 70%. 0.705.
Okay, so this is the unlevered, beta of the unlevered firm.
Hmm.
There is no leverage, there is no
Hmm.
debt here.
Hmm.
Then beta of the private company,
Hmm.
that means NSDL, is equal to beta of unlevered.
Hmm.
Okay. Into, now I will compound it with its debt to equity. This is the formula. Okay, so beta is unlevered is 0.705
Hmm.
into 1 plus, let's say its debt is higher than that. It's maybe like 0.8 for every one equity. 0.8 for every one equity.
Then the
So
debt will be lower, na? 0.8
here it
for
is,
one equity.
that will be lower. Yeah, that will be lower. Here it is 1. Okay, 30%. Now you calculate all this. This is 70% of 0.8. Overall, how much is it coming to?
1.09.
1.09. This is it. This is beta of the levered company, private company, levered. Okay.
But sir,
Mm.
here through regression, how will we find out beta of a private company?
Through regression, then we have to use linear regression function only.
But then we need a dependable variable, na? Independent variable and dependable variable.
Yeah,
Now,
yeah.
if we don't have stock returns only of the private company, how will we regress it?
No, why can't we have the historical returns?
Of private
We
company is
have
not
to,
listed, na?
yeah, private company is not listed,
Huh.
but you can calculate how much returns it is giving you each year, correct?
How?
You must be doing accounting, right? To calculate how much the profits are going up. Okay.
Okay.
You must be doing by how much returns it is
Huh.
going up
Huh. ROE
fundamentally.
basically. ROE.
Fundamentally.
Okay.
ROE. You do that one. See, it is all, as an analyst, there are 100 ways for you to do this.
Okay.
Okay. Or else you can even, let's say, let's say you are taking the returns of the listed company only, and then you can do some adjustments, some weights you can put, and you can do some adjustments.
Okay.
Like what is the, you can say how much returns you see, let's say year one.
Hmm.
Just this is just whatever is coming into my mind now. I'm telling you, year one, this private company has given 15% return. How much this company has given, listed company? Uh, this is private company and this is listed company. So this is year one. Okay. Year two, year three. You can find the correlation. You can, based on this, you can find out the regression.
Okay. So we don't have to, it's not compulsory to do it with the index only. We can do it with anything, like
Yeah,
if we want to
yeah,
find out.
yeah.
But the beta is like how much the company is risky as compared to the market, na?
Huh.
So we have to take market as our independent
No, you
variable.
said like returns you wanted to find out. You said, no, how much returns?
Ha,
Okay, you are
yeah.
saying now.
So as per returns only. So if I have my returns of market and my this company, dependable company that I am, the Y return and the X return. So I have the X return of market and Y return of my company.
Hmm.
So through that I can find out the beta. But if my Y company is not listed, then how will I regress?
Okay, so basically, what do you want to find out? You want to find out beta only, correct?
Yeah, beta, but through on the basis of market. Like if this company is 15% risky, then how much is it risky compared to the market? If the market is this much, then how much is this much?
No, you are saying through uh through the okay. See, you are getting ready-made beta, right? Which is from the public company only, na, and which
Yeah,
is from the market only.
yeah.
So why will you do like this? I have not understood.
No.
Hmm.
My question was,
Huh.
like, we find out beta of every company.
Huh,
Now,
yeah.
beta is something that it tells you how much the company is more risky
Huh,
compared to the market.
huh.
So, if I want, if so, how do we find out the beta of that company? We do that regression with the market. We regress it with the market, that company. For example, Tata Motors. We want to find out the beta of Tata Motors, how much Tata Motors is more riskier than the market. So we will do the regression. We will find out the this
Hmm.
beta. But what if I don't have the returns of the Tata Motors, like daily returns? Then how will I regress it?
No, are you speaking about beta or are you speaking about returns? If you are speaking about beta,
Huh?
then that beta I will get it for a public limited company.
Yeah.
Then
But to find out beta, we need daily returns, na?
daily returns of the public company, right? Tata Motors.
Yeah, and the private and the index. So daily returns of index, daily returns of this uh, public
No,
company, and
see, this is Tata Motors.
yeah,
Now, Tata Motors beta, I am going to get anyways.
yeah.
Okay,
Yeah.
so with the help of this beta, I am going to calculate private company's beta.
Okay.
Where is the problem then? This company is publicly listed.
Huh.
So, whatever its return is, I am going to get its beta.
Huh.
And through this formula, I am going to get this private company's beta.
Okay.
So,
Okay.
where is it like what I cannot do here? Nothing like that, right?
Huh. So a private company, you cannot get a beta of a private company in the same way you got it for Tata Motors.
Private company, the way you got it for Tata Motors, you cannot get it. Yeah.
Hmm. Okay. Yeah, got it.
Then expanded CAPM. Okay, expanded CAPM and build-up method. Expanded CAPM version includes additional premium for size and firm-specific unsystematic risk. So, okay, expanded CAPM. And build-up method can be used when it is not possible to find comparable public firms for beta estimation. Beginning with the expected return on the market, that is, beta is implicitly assumed to be 1. Premiums are added for small size industry factors and company specific. Okay, so we'll see this now. So CAPM will be okay. So CAPM, yeah, you just go through this question now
Yeah.
first.
That's
Okay. Private company required rate of return. Okay, so here calculate the required rate of return using CAPM, the expanded CAPM and the build-up method. Okay. First one is CAPM. So risk-free plus beta of return of the market minus risk-free. Risk-free is 3.6 percentage plus beta is 1.3. Return of the market. Equity risk premium is 6 percentage. Just calculate this.
yeah. 11.4.
Now expanded CAPM is equal to risk-free plus beta into RM minus RF plus beta into, it indicates additional premium for size. Size plus beta into firm specific risk. So risk-free rate is 3.6 plus 1.3 into 6 percentage, which we have already calculated. 11.4 percentage plus small stock premium is 3 percentage. Size is 3 percentage, but beta is not given. Okay. So beta is not given. So we'll take as 1 plus
But beta for what? Acha, ha, okay.
firm specific risk. That means company specific 2 percentage. So plus 3 percentage plus 2 percentage. So 16.4 percentage. Okay. This you have to remember. Size and firm specific will be added up. Then build up. So build up method, you will not use only the beta. All beta will be considered as 1. Okay. So here it is risk free plus RM minus RF. Okay. Plus now there is one more addition also. You will also add, see, beta is simply assumed to be 1, and you will also add industry factors risk. So industry factor premium is, industry risk is 1 percentage. Industry risk plus size plus firm specific.
That firm specific risk is can also be beta, no?
No, unsystematic risk. Company, within the company, there can be some unsystematic risk. Let's add up all this.
Hello.
Hmm.
Yeah. That is.
Hmm.
Wait.
5, 6, 12,
12,
15.6.
15.6.
Hmm. The next one is the WACC using the capital structure of the optimal capital structure, assuming cost of equity is 16. Optimal, this is current and this is optimal. Optimal debt to total capital is 12%. So that means equity should be 88%. Debt should be 12, correct?
Optimal debt to capital.
Debt to equity or debt to capital, they said 12%. So that
Okay.
means if your capital is 100, debt should be 12. That means equity is 88.
88%. Yeah.
Okay. So now my WACC is equal to cost of equity into weight of equity plus after tax cost of
Cost of
debt
debt into weight of
into weight of debt, weight of debt. Yeah.
88% into what is cost of equity? 16%.
Yeah.
Cost of debt is
Weight of equity is 88%. Okay. Plus after tax cost of debt.
9
So before tax cost of debt is 9% into 1 minus tax is 30%
into
into 12%. Now just calculate.
14.83.
14.8. Okay, there is one more question. Comment on the appropriate capital structure weights. The current capital structure reflects the
We
what
have
is the
not
current capital
calculated
structure?
current capital structure.
No, here it is, no, current total debt to capital 3%. So that means they have to increase debt.
But we
Optimal
have
is
to
12.
calculate the WACC of that current capital structure. Now, if the WACC is higher, then we'll increase or decrease. Or else, if the WACC is lower than the optimal capital structure, we'll go with
It is
the
already calculated. The moment they say optimal, that means
uh,
WACC has been factored in.
okay,
Otherwise, how can you say optimal? You
okay,
could have, instead of saying 12%, you could have said 20%. WACC has been factored in, and then whether they can pay,
huh,
till 12%, they are comfortable.
okay,
It is benefiting them, right?
okay,
That's what optimal means. No? That means it has already been calculated. So
yeah,
from 3 to 12, they should now borrow money.
yeah.
Okay. Now you read this. The conservative debt they are using now 3%.
Conservative debt means
Very less, 3%.
very less. Okay, Done.
Done. Okay. Strategic and non-strategic buyers. These are all easy. See, if you are a strategic buyer, you would pay more. Why? Because see, say for example, uh, there is one chemical company. Now, your company, if there is one another, this is your company. If your company uses this chemical, then it's a strategic buying. That means you can, you don't mind paying more also, because it is assuring you some raw materials or some product to you at the lower cost in future. Or there may be another company which has no connection with this chemical company. They are buying just to diversify. Then this company will say, this company will value this company, this another company will value the chemical company at the lower rate only, because they will buy this chemical company only if it is available at a cheaper rate. So strategic buyer will pay more, non-strategic buyer will pay less, because non-strategic buyer's purpose is only to diversify. Strategic companies' purpose is to reduce the cost, to bring in synergy. Is it okay? So that's what it is. Just go through this question now.
Thanks, sir.
Okay. An analyst is valuing, two different potential buyer. Buyer A is a firm in the same industry as the target company, which expects to reduce cost at the target by eliminating redundancy. Buyer B is an unrelated industry. That means just to diversify. The normalized EBITDA for each buyer is given. Now both, so here, see, now reported EBITDA, current executive compensation, market-based compensation. So strategic buyer and non-strategic buyer. So reported EBITDA 404.8 million, current executive compensation 900, but market-based compensation 600. So they both will get. They see, this is 4800. This is also 4800. So they both will get extra 300 because they will reduce the compensation to market-based one. So 300. Then current SGA expenses 8 million and current SGA expenses after synergy. So after synergy, so the strategic buyer will get 400, he will save.
More.
So he will save strategic. he is not going to save that amount.
Yeah. So
So
5.5.
you calculate now.
5.5.
Hmm.
And that is 5.1.
Hmm. So this is what they will earn. Okay. Then discount for lack of control. Okay. So discount for lack of control. Okay, you just go through this, all the highlighted points.
Yeah. That's it.
Done. Okay. Okay. Uh, hmm. Now the formula for discount for lack of control is this formula you have to remember. Discount for lack of control is equal to 1 minus 1 by 1 plus control premium. Okay. Now let's try to understand the intuition behind this. Say for example, imagine discount value of your minority shares is equal to value of the controlling shares. Which one will be higher and which one will be lower?
Value of
Controlling shares or minority shares?
value of minority shares will be higher.
No, controlling shares will be higher, na?
Value, the total value. Yeah, okay. The controlling share will be higher. Yeah.
Okay, so now minority shares, that means he will discount it, and that discount is called control premium.
Yeah,
That
because
means this part 1 by 1 plus, this is all discount factor.
yeah.
Okay.
So to bring it to level with
He
the
will
minority.
discount.
Yeah.
He will discount. If the controlling, if you are acquiring a company, if it is 100 rupees, minority share might pay only 80 rupees because he will say, I'm anyways not going to control the company. But the controlling person will give 100 rupees. Why? Because he's getting voting rights and he's going to actually participate. He will get to rule the company, right? Okay. Okay. Now that means I can say this 1 by 1 plus CP. This is what? This is the discounting factor. Okay, that means one discounting for lack of, so that means so discounting for lack of control is if the total amount is 1 rupee minus this is the discount I'm giving. This is the factor, discounting factor. So it will be 1 by 1 plus controlling premium. So this is the total discount for lack of control. Discount for lack of control. Have you understood this one?
Hello.
Yeah, have you understood this
Yeah,
one?
yeah, yeah.
Okay, so for example, if controlling premium is 25 rupees, so 1 plus 25 percentage, 25 percentage controlling premium extra. So out of 1 rupee, this much is the controlling premium. So that comes to, just calculate, is it coming to
Yeah.
20 percentage?
Yeah, it's 20%.
Yeah. So this is 1 rupee and this is that 1 rupee's reduced value discount. So you will get discount for, so this is 1 rupee total value. This is the total value is discounted value. So remaining is all the discount. So I can say this is for controlling and this is for minority. Okay, this is a discount. So you will get total discount.
So if he is paying 1 rupee, I have to pay 0.8.
0.8. Yeah.
Okay.
Okay. Similarly, discount for lack of marketability as well. This is a, there are 3 ways to find out discount for marketability. Just go through this once and then explain it.
That's it.
Yeah. Okay, so first one, in the first method, discount for lack of marketability, the price of the restricted share is compared to the price of publicly traded shares. So this is straight one line. Okay. Section, not section, this is SEC rule, Securities and Exchange Commission rule 144. For example, may restrict the sale of shares acquired in a firm before its IPO. Okay. So you have to compare it with, so it is just like NSDL and CDSL. Okay, or NSE and BSE shares. Okay, and then we will come to know what is the discount for because of lack of marketability, because you cannot immediately sell it. Then the second one, the price of pre-IPO share is compared to that of post-IPO. However, one complicating factor is that post-IPO firms are generally thought to have more certain cash flows and lower risk. So the estimated discount for lack of marketability may not be purely reflecting changes in marketability. That's one theory. But this line is okay. You are able to understand.
Yeah, because the post IPO firms have more cash flows and lower risk, the discount is less.
Okay. Third one. Um, Third one is an interesting one. Third one is an important one also. Third one is, see, it estimates discount for lack of marketability as the value of the at the money put options. So at the money put option means what now? This is put options at the money. This is XY. Now you have the right to sell 100 rupees product at 100.
Yeah.
And imagine its premium is 10 rupees. That means 10 rupees is the discount for lack of marketability, because finally you are going to get only 90 rupees then.
Hmm.
To get the right to sell 100 rupees product at 100,
Hmm.
okay, you are paying 10 rupees.
Hmm.
So that 10 rupees is the discount. So that premium will be considered as the discount.
Okay.
Keeping that in mind, you read now all this. Is it okay?
Sir, I'm reading it.
Okay.
Yeah, done, sir.
Okay. Now total discount. So total discount is total value of the company is 1 rupee minus so 1 minus discount for lack of control into, because it is
Hmm.
and 1 minus discount for lack of marketability. Okay, so here in this case 1 minus 20% lack of control and 13% lack of marketability. So total discount is, just calculate this part.
Yeah.
That means this will be 0.80 into
Into point
0.7887.
87.
Is it
Zero
coming to,
point 696.
so 1 minus 0.696. So is it coming to 30.4 around?
30 31.4.
30.4. I think some calculation then mistake.
Wait, I'll do. Yeah, 30.4. Yeah.
Okay. This is it.
Hmm.
Then next sum. This is an easy sum only. This is also easy sum only.
I'll
Then,
try it, sir. If I don't get it, I'll come to it.
it's very easy only.
Yeah.
There is nothing so very difficult here. Okay, I think it will take like maybe half an hour more. So what we will do, we'll stop now here.
Okay.
You try this sum.
Yeah.
Okay, and then tomorrow then we will finish it off this
Yeah.
sum.
Okay.
Okay, we'll stop now here.